Gold at historic highs. How not to go broke. Jim Simons, ladies and gentlemen, good afternoon. Picture this for a moment. Gold has just hit a new all-time high. The headlines are screaming. Social media is flooded with stories of people making fortunes overnight. Your neighbor, who 6 months ago knew nothing about precious metals, is suddenly an expert telling you how much money he's made. And you're sitting there wondering if you've missed the boat. Or worse, you're thinking about jumping in right now at these elevated prices because you can't stand the idea of being left behind while everyone else gets rich. This is the moment when most people make the worst financial decisions of their lives. Not because they lack intelligence, not because they don't have good intentions, but because they're human. And humans are wired to follow the crowd, especially when that crowd appears to be winning. What I'm about to share with you over the next several minutes could be the difference between building lasting wealth and watching your capital evaporate in a frenzy of bad decisions driven by emotion rather than logic. Gold at historic highs is not a signal to panic. It's not a signal to rush in blindly. It's a signal to pause, to think, and to understand what's really happening beneath the surface. Because the truth is, the moments that feel most urgent are often the moments that require the most restraint. And if this kind of clear-headed analysis helps you see through the noise and make better decisions for your financial future, then subscribe to this channel right now so you don't miss the next insights and alerts we'll be sharing in the weeks ahead. Now let's get into it. When gold reaches new peaks, something profound happens in the psychology of markets. It's not just about the metal itself. It's about what that peak represents to different groups of people. For those who have been holding gold for years, it feels like validation. For those who dismissed it, it feels like regret. And for those who are just now paying attention, it feels like opportunity mixed with fear. That cocktail of emotions creates conditions where rational decision-making goes out the window. Think about how markets actually work at a fundamental level. Prices don't move in straight lines. They move in cycles, driven by human behavior. When an asset is cheap and unloved, the smart money accumulates quietly. When it starts to rise, the cautious money begins to take notice. And when it reaches new highs, when everyone can see it, when the media is talking about it, that's when the masses arrive. And the masses always arrive late. This isn't a criticism. It's just reality. Most people don't have the time, the inclination, or the training to spot opportunities early. They rely on signals that are obvious, and the most obvious signal is price itself. When something is going up dramatically, it feels safe. It feels like momentum is on your side. But what's actually happening is that you're entering at the stage where the early participants are preparing to exit. That's the paradox of historic highs. They feel like the beginning of something big, but they're often closer to the end of a particular move. Now, does that mean gold is about to crash? Not necessarily. Historic highs can lead to even higher highs. Assets can remain expensive for longer than anyone expects. But what it does mean is that the risk-reward equation has shifted. When you buy at historic highs, you're paying a premium for safety that may not actually exist. You're assuming that the trend will continue indefinitely, and you're exposing yourself to the possibility of a sharp reversal that could wipe out years of gains in a matter of weeks. Let me be very clear here. This content is educational and not financial advice. Its purpose is to help you think more clearly about your decisions, not to tell you what to do with your money. What I want you to understand is the mechanics of how people go broke even when they're investing in something fundamentally sound like gold. Because going broke isn't just about picking the wrong asset. It's about picking the right asset at the wrong time, in the wrong way, with the wrong mindset. The first mistake people make at historic highs is assuming that price equals value. They see gold at $3,000 an ounce, and they think, well, if it's at 3,000, it must be worth 3,000. But price and value are not the same thing. Price is what you pay. Value is what you get. And at historic highs, what you're often paying for is not just the metal itself, but the collective fear, greed, and momentum of everyone else in the market. You're paying for sentiment, and sentiment is the most unreliable foundation for any investment decision. Value, on the other hand, is determined by fundamentals. How much gold exists, how much is being mined each year, what is the demand from industries, central banks, and investors, what is happening with currencies, debt levels, and monetary policy. These are the questions that determine the long-term value of gold. And here's the uncomfortable truth. Those fundamentals don't change just because the price hits a new high. Gold doesn't suddenly become twice as useful or twice as scarce just because the market gets excited. What does change is perception. And perception is powerful. It can drive prices far beyond what fundamentals justify. It can also drive them far below. That's why understanding the difference between price and value is so critical. When you confuse the two, you end up buying expensive assets thinking you're getting a bargain simply because everyone else is doing the same thing. The second major mistake is succumbing to FOMO, fear of missing out. This is perhaps the most destructive force in all of investing, and it's especially potent when an asset is making headlines. You see gold surging, you see people talking about it, you see charts going vertical, and a voice in your head starts whispering, if you don't buy now, you'll regret it forever. That voice is lying to you. FOMO is not rational analysis. It's panic dressed up as urgency. It's your brain trying to protect you from the social pain of being left out, but in doing so, it's actually pushing you toward financial pain. Because when you act out of FOMO, you're not making a decision based on your own research, your own risk tolerance, or your own financial situation. You're making a decision based on what other people are doing. And other people's decisions are based on their circumstances, not yours. Let me give you a concrete example. Imagine someone who bought gold at $800 an ounce years ago. That person might be selling at $3,000 and walking away with a massive profit. To them, 3,000 is a great exit point. But if you're buying at 3,000 because you're afraid of missing out, you're not in the same position as that seller. You're starting your journey at the point where they're ending theirs. Your risk is their reward. And if the price pulls back even slightly, you're immediately underwater while they're already counting their gains. This is the asymmetry that FOMO blinds you to. It makes you think you're joining a winning trade when in reality you're often providing the exit liquidity for those who got in early. That doesn't mean you'll never make money. Markets can stay irrational longer than you expect, but it does mean that your margin of safety has evaporated. You're playing a much more dangerous game than you realize. The third mistake, and this one is subtle, is abandoning discipline. When markets are calm, it's easy to have rules. You tell yourself, I'll only allocate 10% of my portfolio to gold. I'll dollar cost average. I'll rebalance regularly. I won't chase price. But when euphoria hits, those rules feel like obstacles. They feel like the things preventing you from making life-changing money. So you throw them out, you go all in, you leverage up, you convince yourself that this time is different. And maybe it is different. Maybe gold really is going to $10,000. But even if it is, abandoning discipline is still a mistake, because discipline isn't about being right or wrong on a single trade. It's about surviving long enough to benefit from being right over time. It's about protecting yourself from the inevitable moments when you're wrong. It's about ensuring that one bad decision doesn't destroy everything you've built. Think of discipline as the guardrails on a mountain road. When the weather is clear and the road is straight, those guardrails seem unnecessary. You could drive without them just fine, but the guardrails aren't there for the easy stretches. They're there for the moments when visibility drops, when the road curves sharply, when one mistake could send you over the edge. That's what discipline does in investing. It keeps you on the road even when conditions deteriorate. At historic highs, conditions are always more fragile than they appear. The higher the price, the more unstable the structure becomes. It's like a tower of blocks. Each new block added makes it taller, more impressive, but also more vulnerable to collapse. Discipline is what prevents you from being the person who adds the final block right before the whole thing comes down. So how do you actually avoid going broke when gold is at these levels? Let's walk through the tactics that separate those who build wealth from those who destroy it. The first tactic is to separate emotion from analysis. This sounds simple, but it's extraordinarily difficult in practice. Emotion is automatic, it's fast, it's persuasive. Analysis, on the other hand, requires effort. It requires you to slow down, to question your assumptions, to look at data rather than headlines. Start by asking yourself a very basic question. Why do I want to buy gold right now? If the answer is because the price is going up, that's emotion. If the answer is because everyone else is buying, that's emotion. If the answer is because I'm afraid of missing out, that's emotion. None of those are valid reasons to deploy capital. A valid reason would sound more like this. I believe the long-term fundamentals for gold remain strong due to currency debasement, rising debt levels, and geopolitical instability. I have analyzed my portfolio and determined that increasing my allocation to gold fits within my risk tolerance and overall strategy. I understand that I may be buying near a short-term peak, but I'm prepared to hold through volatility because my time horizon is measured in years, not weeks. Do you see the difference? The first set of answers is reactive. The second is proactive. The first is driven by fear. The second is driven by strategy. If you can't articulate a clear, emotionless reason for your decision, then you shouldn't be making that decision, period. The second tactic is to avoid binary thinking. Binary thinking is when you see the world in absolutes. Gold is either going to the moon or it's going to crash. You either buy now or you miss out forever. You're either all in or you're a coward. This kind of thinking is toxic because it eliminates nuance, and markets are nothing but nuance. The reality is that there are many possible outcomes. Gold could continue rising for months or years. It could plateau here and trade sideways. It could pull back sharply and then resume its uptrend. It could enter a prolonged bear market. Nobody knows which of these will happen. And anyone who tells you they know with certainty is either lying or deluded. What you can control is how you position yourself across those different scenarios. You don't have to bet everything on one outcome. You can allocate in a way that allows you to benefit if gold continues rising while also protecting yourself if it doesn't. This is called managing risk, and it's the single most important skill in investing. One approach is to scale into a position rather than entering all at once. Let's say you've decided you want to increase your gold allocation. Instead of buying everything today at historic highs, you could divide your planned investment into 5 or 10 tranches and deploy them over the coming months. This way, if prices continue rising, you still participate. If prices pull back, you get to buy at better levels. You're not trying to time the perfect entry. You're acknowledging that you don't know what will happen and positioning accordingly. Another approach is to set predefined rules for when you'll add to your position and when you'll reduce it. For example, you might decide that if gold pulls back by 15% from current levels, you'll buy more because you view that as a better value. Conversely, If it rises another 20%, you might trim your position to lock in some gains. These rules remove emotion from the equation. You're not reacting to headlines or gut feelings. You're following a plan you made when you were calm and rational. The third tactic, and this is crucial, is to understand what you're actually buying. Not all gold exposure is created equal. You can buy physical gold coins or bars. You can buy shares in gold ETFs. You can buy mining stocks. You can buy gold futures or options. Each of these has different characteristics, different risks, and different tax treatments. Physical gold gives you direct ownership and eliminates counterparty risk, but it comes with storage costs and liquidity challenges. ETFs offer convenience and liquidity, but they introduce counterparty risk and management fees. Mining stocks give you leverage to gold prices, but they also expose you to company-specific risks like management quality, operational issues, and geopolitical factors in the countries where they operate. Futures and options offer even more leverage, but they can also amplify losses and come with expiration dates that force you to make decisions on someone else's timeline. The point is that buying gold is not a single decision, it's a series of decisions. And if you don't understand what you're actually getting when you click that buy button, you're setting yourself up for surprises, unpleasant ones. Take the time to educate yourself. Read the prospectuses. Understand the fee structures. Know the risks. Don't assume that just because something is labeled gold, it's automatically safe or equivalent to every other gold investment. The fourth tactic is to keep perspective on portfolio construction. Gold is not a portfolio. It's a component of a portfolio. And the role it plays in that portfolio matters more than its individual performance. For most investors, gold should serve as a hedge, a form of insurance against scenarios where other assets perform poorly, currency collapse, hyperinflation, geopolitical chaos, financial system instability. Insurance is valuable, but you don't buy insurance expecting it to make you rich. You buy it expecting it to protect you when things go wrong. If gold appreciates significantly, that's a bonus, but it's not the primary reason you hold it. The primary reason is diversification and risk management. At historic highs, this perspective becomes even more important. If gold has already run up dramatically, and if it now represents an outsized portion of your portfolio due to that appreciation, you're no longer diversified, you're concentrated. And concentration is the opposite of insurance. It's speculation. There's nothing wrong with speculation if you understand that's what you're doing and you can afford to lose. But don't confuse speculation with prudent risk management. This might mean that the right move at historic highs is actually to rebalance, to trim your gold position back down to your target allocation and redeploy that capital into other areas that haven't run up as much. This feels counterintuitive. You're selling something that's winning, but that's exactly the point. You're taking profits, you're locking in gains, you're restoring balance, and you're ensuring that if gold does reverse, you're not overexposed. The fifth tactic is to recognize the signs of a bubble. Not every historic high is a bubble, but many are. And bubbles have characteristics you can identify if you know what to look for. Euphoria, a sense that this time is different. Mainstream media coverage that shifts from skeptical to celebratory. Retail investors flooding in. Valuations that become detached from fundamentals. A narrative that justifies any price. When you see these signs, it doesn't mean you have to sell everything and run for the hills, but it does mean you should be cautious. It means you should tighten your risk management. It means you should prepare emotionally for the possibility that the party might end sooner than you expect. One of the clearest signs of a bubble is when people stop talking about fundamentals and start talking only about price. When the conversation shifts from why gold is valuable to how high gold can go, you're entering dangerous territory. Because once price becomes the only thing that matters, once the narrative is purely momentum driven, you're no longer investing. You're gambling on the greater fool theory. You're hoping that someone else will pay even more than you did. And that game always ends the same way. The music stops, the chairs disappear, and the last ones standing are left holding the bag. The sixth tactic is to ignore the noise. This is easier said than done, especially in the age of social media, where everyone with an internet connection has an opinion and a platform. You'll see people posting screenshots of their gains. You'll see influencers making bold predictions. You'll see headlines designed to trigger fear or greed. And all of it will feel urgent. All of it will feel important, but most of it is noise. It's not information. It's entertainment. It's distraction. It's other people's agendas packaged as insights. The only way to cut through it is to have a clear framework for filtering information. Ask yourself, is this data or is this opinion? Is this based on evidence or is this based on emotion? Is this person qualified to make this claim or are they just repeating what they heard somewhere else? Most of what you see online fails those tests. And once you start applying them rigorously, you'll realize how much of your mental energy has been wasted on things that don't matter. That energy is finite. Use it wisely. Focus on the signals that actually affect your decisions. Everything else is static. The seventh tactic is to have an exit plan. This is the one thing almost nobody thinks about when they're caught up in the excitement of a rising market. They know why they're buying. They know how much they're buying, but they have no idea when or why they would sell. And without an exit plan, you're flying blind. An exit plan doesn't have to be complicated. It can be as simple as saying, I'll sell half my position if gold reaches a certain price level, or I'll sell if my original thesis for owning gold is no longer valid, or I'll sell if gold becomes more than a certain percentage of my portfolio. The specifics don't matter as much as the fact that you have something in place before emotions take over. Because here's what happens without an exit plan. Gold goes up and you feel like a genius. You start imagining what you'll do with all the money you're making. Then gold starts to pull back. At first, you're not worried. It's just a normal correction. But then it keeps falling. And you tell yourself it'll come back. It always comes back. Except it doesn't. At least not right away. And by the time you finally capitulate and sell, you've given back most or all of your gains. That's the pattern. Over and over. People ride the elevator up and then ride it all the way back down because they had no plan for when to get off. An exit plan forces you to think about that in advance. It forces you to define success. And once you've defined success, you can actually achieve it instead of endlessly chasing some imaginary peak that never materializes. Now, let's talk about a concept that doesn't get enough attention in these discussions. The concept of opportunity cost. When you deploy capital into gold at historic highs, you're not just taking on the risk that gold might fall. You're also accepting the risk that other assets might perform better. And if they do, you've missed out on those gains by being over-allocated to gold. This is particularly relevant right now because we're in an environment where multiple asset classes are showing interesting setups. Certain sectors of the stock market are undervalued. Bonds are offering yields that haven't been available in years. Real estate in some markets is presenting opportunities. Commodities beyond gold are showing strength. The point is that capital is finite. Every dollar you put into gold is a dollar you can't put somewhere else. That doesn't mean gold is the wrong choice, but it does mean you need to think holistically. You need to compare the expected returns and risks across your entire opportunity set, not just focus on the one thing that's making headlines. Sometimes the best investment decision is the one that doesn't make headlines, the boring one, the unsexy one, the one that quietly compounds while everyone else is chasing the shiny object. Opportunity cost also applies to time. Even if gold eventually goes higher from here, it might take years. It might trade sideways for a long time before breaking out again. During that time, your capital is locked up, earning no return. Meanwhile, other assets could be delivering steady gains. You have to ask yourself, is the potential upside in gold worth the potential time cost of holding it while other opportunities pass you by? There's another dimension to this that's worth exploring. The psychological cost of being wrong when you buy at historic highs and the price subsequently falls. It's not just your portfolio that takes a hit. It's your confidence. It's your belief in your own judgment. And that psychological damage can be far more costly than the financial loss because it affects every decision you make going forward. You become gun shy. You second guess yourself. You either become too conservative and miss real opportunities, or you become reckless trying to make up for your losses. Either way, you're operating from a place of emotional injury rather than clear thinking. This is why avoiding bad decisions is often more important than making great ones. A bad decision at the wrong time can haunt you for years. Let's also address the idea of dollar cost averaging, because this is a strategy that gets thrown around a lot, especially in situations like this. The idea is simple. Instead of trying to time the market, you invest a fixed amount at regular intervals, regardless of price. Over time, this smooths out your entry point. You buy more when prices are low and less when prices are high. In theory, this sounds great. And for long-term investors in stable markets, it can be effective. But at historic highs, dollar cost averaging has a hidden flaw. You're committing to buy regardless of price, which means you could end up deploying significant capital at the worst possible time. If gold is in a bubble and you're dollar cost averaging into that bubble, you're not reducing risk. You're systematically adding to a losing position. A better approach might be value averaging, where you adjust your purchases based on how far the price has moved from a target level. If prices rise significantly, you buy less or nothing. If prices fall, you buy more. This way, you're not blindly following a schedule, you're responding to value. The key insight here is that no strategy is foolproof. Every approach has trade-offs. What matters is that you understand those trade-offs and choose the approach that aligns with your goals, your risk tolerance, and your time horizon. There's no one-size-fits-all answer. Anyone who tells you there is doesn't understand how markets work. Let's shift gears and talk about what actually drives gold prices over the long term, because understanding this will help you assess whether current levels make sense or whether they're disconnected from reality. Gold is fundamentally a confidence asset. Its value rises when confidence in other systems falls, confidence in currencies, confidence in governments, confidence in financial institutions, confidence in the future. When central banks are printing money recklessly, gold tends to do well. When debt levels are unsustainable, gold tends to do well. When geopolitical tensions flare, gold tends to do well. When inflation erodes purchasing power, gold tends to do well. These are the fundamentals that matter, not the day-to-day price action, not the technical charts, not the headlines. If those fundamental drivers are still in place, and right now many of them are, then gold's long-term case remains intact. The question is not whether gold is valuable. The question is whether it's overpriced relative to those fundamentals at this particular moment. And that's a much harder question to answer because it requires you to make judgments about things that are inherently uncertain. How much more money will central banks print? How high will debt levels go? How bad will geopolitical situations become, nobody knows. What you can do is look at historical precedents. Look at other times when gold reached similar levels of valuation relative to other assets or relative to money supply. See what happened next. Did gold continue rising? Did it consolidate? Did it correct sharply? History doesn't repeat, but it often rhymes. And those patterns can give you a sense of probabilities, even if they can't give you certainties. One useful metric is the gold to money supply ratio. When gold is expensive relative to the amount of money in circulation, it tends to underperform going forward. When it's cheap relative to money supply, it tends to outperform. Right now, depending on how you measure money supply, gold is somewhere in the middle to upper range. It's not screaming cheap, but it's also not at the extremes we saw in past bubble peaks. That suggests there's room for further upside, but it also suggests that the easy gains have probably already been made. Another consideration is real interest rates. Gold tends to perform best when real interest rates are negative, when the return on cash or bonds after adjusting for inflation is below zero. Right now, real rates are positive in many markets, though not dramatically so. That creates a headwind for gold because there's an opportunity cost to holding an asset that doesn't yield anything. As long as that dynamic persists, gold's upside may be more limited than it would be in a deeply negative real rate environment. None of this is meant to discourage you from owning gold. It's meant to help you calibrate your expectations and your position sizing. If you understand the context, you can make better decisions. You can avoid the extremes of euphoria and panic. You can stay grounded even when everyone around you is losing their minds. Let's also talk about the role of leverage. Leverage is a tool that amplifies both gains and losses. In a rising market, it feels like magic. You're making money not just on your capital, but on borrowed capital. The returns are intoxicating. But in a falling market, leverage turns into a nightmare. Small moves against you can wipe out your entire position. And at historic highs, the probability of sharp reversals is higher, which makes leverage especially dangerous. If you're using leverage to invest in gold right now, you need to ask yourself a very hard question. Can I afford to lose everything I've put in and then some? Because that's the risk you're taking. Leverage doesn't just increase your upside, it increases the likelihood that you'll be forced out of your position at the worst possible time. Margin calls don't wait for the market to recover. They happen when you're already down, when your judgment is clouded by stress, and when your options are limited. The smart players use leverage sparingly, if at all. And when they do use it, they do so with strict risk controls. Stop losses, position limits, diversification. They treat leverage as a precision tool, not a blunt instrument. If you can't do the same, then you shouldn't be using leverage. It's that simple. Another trap people fall into at historic highs is confusing narrative with analysis. Stories are powerful. They're how humans make sense of the world, and markets are full of stories. The story that gold is going to 10,000 because the dollar is collapsing. The story that gold is the only safe asset in a world gone mad. The story that this time really is different. These stories can be compelling, they can feel true, but they're not the same as rigorous analysis. Analysis looks at data, at probabilities, at scenarios. Narrative looks at emotion, at drama, at what feels right. And what feels right is often what leads to the biggest mistakes. When you find yourself getting swept up in a narrative, stop, take a step back, ask yourself, what evidence supports this story? What evidence contradicts it? What would have to be true for this story to play out as described? And what's the probability that all those things will actually happen? More often than not, when you apply that kind of scrutiny, you realize the narrative doesn't hold up as well as you thought. That doesn't mean narratives are useless. They can point you toward areas worth investigating, but they should never be the sole basis for your decisions. They should be the starting point for deeper analysis, not the ending point. Here's a hard truth that nobody likes to hear. Most people who get rich from an asset like gold don't do so by buying at the top. They do so by buying when nobody cares, when the price is boring, when there's no excitement, when it feels like the worst investment in the world. That's when the real wealth is built, because that's when you're buying value, not hype. By the time an asset reaches historic highs, the early buyers are already wealthy. They got in at 800 or 1200 or 1500. They've seen their positions multiply. And many of them are quietly starting to take profits. They're not posting about it on social media. They're not bragging to their friends. They're just systematically reducing exposure and moving capital elsewhere. Meanwhile, new buyers are flooding in, convinced they're about to get rich, not realizing they're providing the exit liquidity for the smart money. This isn't cynical. It's just how markets work. There's always a transfer of wealth from the impatient to the patient, from the emotional to the disciplined, from the late arrivals to the early adopters. The question you have to ask yourself is, which side of that transfer do you want to be on? If you're buying gold at historic highs, you're probably on the wrong side. That doesn't mean you can't make money, but it means the odds are stacked against you in ways they weren't for those who got in earlier. You have less margin for error. You have more downside risk. And you have to be right, not just about the direction, but about the timing. So what's the alternative? If buying at historic highs is dangerous, and if you still believe in gold's long-term prospects, what should you do? The answer is patience. Wait for a better entry point. Gold won't go up in a straight line forever. There will be pullbacks. There will be corrections. There will be moments of fear when everyone who bought at the top panics and sells. Those are the moments when value investors step in. Patience is the hardest strategy to execute because it requires you to do nothing while everyone around you is doing something. It requires you to sit on the sidelines while the party is raging. It requires you to accept that you might miss some gains in the short term in order to position yourself for better gains in the long term. But patience is also the strategy that consistently outperforms over time. The greatest investors in history are not the ones who make the flashiest trades. They're the ones who wait for the right pitch. They're the ones who have the discipline to let opportunities come to them rather than chasing every shiny object that crosses their path. They're the ones who understand that the name of the game is not how much you make when you're right, it's how little you lose when you're wrong. Let me share one more critical insight. The media and financial industry have incentives that are not aligned with yours. Media makes money from attention. The more dramatic the headline, the more clicks they get. Financial institutions make money from transactions. The more you trade, the more fees they collect. Neither of them benefits from you sitting patiently and doing nothing. They benefit from you being active, engaged, and emotional. That's why the message is always the same. Buy now, before it's too late. This is your last chance. You can't afford to miss this. It's designed to trigger urgency and fear because those emotions drive action, and action drives revenue for them, not necessarily profits for you. Understanding this dynamic is liberating. Once you realize that most of the noise in the financial world is not there to help you, but to extract value from you, you can tune it out. You can focus on what actually matters: your goals, your risk tolerance, your time horizon, your strategy. Everything else is just interference. Now, as we come toward the end of this discussion, let me tie it all together. Gold at historic highs is not inherently good or bad. It's a condition, a state of the market, And how you respond to that condition will determine whether you build wealth or destroy it. The tactics we've covered are not complicated. Separate emotion from analysis. Avoid binary thinking. Understand what you're buying. Keep perspective on portfolio construction. Recognize bubble signs. Ignore noise. Have an exit plan. Consider opportunity costs. Avoid leverage. Question narratives. Practice patience. None of these require genius. They require discipline. And discipline is what separates those who endure from those who blow up. Markets will always offer opportunities to get rich quick. And markets will always punish those who take the bait without thinking. Your job is to be the person who thinks, who pauses, who questions, who prepares. Gold has been a store of value for thousands of years. It will likely continue to be one for thousands more. But that doesn't mean every moment is the right moment to buy. Sometimes the right move is to wait. Sometimes the right move is to sell. Sometimes the right move is to do nothing at all. The key is knowing which move is right for your situation, not for someone else's. So here's what I want you to take away from this. If you're sitting on unrealized gains in gold, congratulations, you did something right. Now protect those gains, rebalance if necessary, take some profits, don't get greedy. If you're thinking about buying gold for the first time because of the headlines, stop. Ask yourself why. If the answer is FOMO, walk away. If the answer is a clear strategic rationale, then proceed cautiously with proper position sizing and risk management. And if you're somewhere in between, use this moment as an opportunity to educate yourself, to build a framework, to develop the skills that will serve you not just in this market cycle, but in every cycle to come. Because markets will always test you. They will always try to separate you from your capital. And the only defense is knowledge, combined with discipline. Gold at historic highs is a test. It's a test of your emotional control. It's a test of your understanding of value. It's a test of your ability to think independently when the crowd is screaming at you to conform. Pass that test, and you'll be fine. Fail it, and you'll learn an expensive lesson. The choice is yours. The markets don't care what you decide. They'll keep moving with or without you. But your financial future very much depends on how you navigate moments like these. So choose wisely. Think clearly. And remember that in investing, as in life, the tortoise usually beats the hare. Not because the tortoise is faster, but because the tortoise knows the race is long and paces accordingly. Thank you for your time and attention. Stay disciplined, stay informed, and above all, stay rational in a world that profits from your irrationality.